Hey everyone, so if you've been following the channel for a while, you would know that every 3 months since I started this YouTube channel, I have done a video where I detailed my annual returns of my overall investment portfolio. And through those videos over the past 3 years, some years have been okay, some slightly beating the market, some slightly underperforming the market, and some years have just been incredible. In 2020, last year for example, my portfolio beat the market by 5 to 10 times, depending if you're comparing it to the US or Australian market. However, none of those single year performances mean anything if you are a long-term investor, because a single year's performance or returns is completely irrelevant if it comes at the cost of strong and consistent multi-year returns. So as promised, in today's video, I'm going to be breaking down my 3-year compounded returns for my entire stock market and investment portfolio. And the reason why I can do that and not have to get out a spreadsheet and run all these crazy mathematical calculations for all of my trades over the past 3 years is because since 2017, I have entered every single trade made in my investment portfolio into a portfolio tracking software called SHARESIGHT. Now, SHARESIGHT is not the topic of today's video, but I have a full review on it if you're interested in using it to track your portfolio and how you can benchmark your portfolio against other indices using it. I'll leave a link to it down in the description below. And my very, very short promotion of SHARESIGHT is if you use my link down in the description below, you can get 4 months free off a yearly subscription. But that is not the topic of today's video, so that is all I'm going to say about SHARESIGHT, but they are the software that I'm using in order to show these returns today. So in today's video, I'm going to start with a full breakdown of the composition of my portfolio in terms of index funds, individual stocks from the US and Australia, cash, and then any other assets that I have in this investment portfolio. I'm then going to show you the returns of every single component of the portfolio on a compounded basis over the past 3 years. I'm not just going to show you my winners and cherry pick. I'm going to show you everything that I have bought and sold over the past 3 years. And then overall, all of that together, what performance has that driven on my overall portfolio on a 3-year compounded basis. Towards the end, I'll talk about some of the limitations of tracking your portfolio in this way if you are going to go out and use this software to track your portfolio, just some things to keep in mind, and also some investments that I'm potentially going to be making throughout the rest of the year, and then my intentions for the long term for this portfolio. But before we get into that, I am pleased to announce that the Learn by Example platform and community is now open for enrollment for the first time in 3 months. If you're someone who has begun analyzing businesses or stocks using Warren Buffett's key principles and you want to work alongside me, then consider joining our community. You'll be joining a group of 300 like-minded investors. You get instant access to over 55 hours of stock analysis reports and presentations on real companies that I've analyzed that you can use as examples when structuring your own analysis. You get access to a 4-hour course specifically on valuation so that you can use my spreadsheet and some of the other resources in assessing the true value of businesses that you're investing in to make sure you're paying the right price for them. We do weekly Q&A live streams, and something that I added this year is a searchable engine for the catalog of 40 hours of Q&A that we've done over the past 2 and a little bit years. So essentially, when you get access to the platform, you get access to 40 hours of past Q&A sessions, but not only can you go through and watch them, you can actually search through the transcripts so that you can find questions that I've answered for students for any time over the past 2 years, which is a terrific resource when you're getting started. And there's even more stuff that I could spend a long time talking about, but I want to get to today's video. So if you want to learn more or you want to sign up at the discounted rate while enrollment is open, then all of the information is down in the description below. It'll be right at the top of the description, so you won't miss it. And at the start of enrollment, which I opened yesterday, there was 50 spots available. Just checking it now, there's about 30 left. So these spots will go quick. So if you're interested, make sure you jump down there, check out the information page, reach out to me via email or schedule a call if you are interested in learning more about it before you sign up. And as I said, everything is down in the description below. The first thing I wanted to do in today's video is go through the portfolio's composition in terms of index funds, individual stocks, cash, and other assets, and explain why they're in the portfolio, and then also what percentage of the portfolio they make up. The first part of my portfolio are index funds, and these are, of course, investments in the stock market that give you broad diversification. I currently hold 3 different index funds, which I'll talk a little bit more about when we're looking at individual stocks and their performance a little bit later in the video. But historically in my portfolio, portfolio, these have made up about 10 to 15% of my overall portfolio, and my intention is to keep them in that range for the foreseeable future so that they can remain a strong foundation of my portfolio that I can be confident in consistently contributing to over time, and be very confident that over time they will grow at a slow and steady pace over many, many decades. I currently hold 3 different index fund stocks in my portfolio, and combined they represent 13.7% of my overall investment portfolio. The next part of my portfolio includes individual stocks, and my goal over the long term, and has been over the past few years, is to follow Warren Buffett and Charlie Munger's core value investing principles and carefully and patiently select a very small number of these businesses to hold over the very, very long term. Over the past 4 or so years, I've been able to find about one really, really good investment in the stock market per year. And that might seem insane that my criteria or that my principles that I'm following are so strict that I only find one good idea or less per year. But finding one per year has been more than enough for me to deliver significantly above average returns in my portfolio. I think it's a mistake to believe that you need to be consistently trading in and out of stocks and building a portfolio of 20 to 30 stocks in order to beat the market. That is certainly not the case. As we'll see in just a second, I tend to find myself spending a lot of time sitting on a large percentage of cash and waiting patiently for an investment opportunity to present itself. And when those opportunities do present themselves, they have been very, very lucrative. And my strategy is to be incredibly disciplined and patient. And when those opportunities arise, to invest significantly into them. And that has worked very, very well over time. Currently, my individual stocks represent a combined 46.6% of my portfolio, but I don't have any strict percentage like the index funds, like I did with the index funds, on how much this goes in my portfolio. I would be very happy for the individual stocks to go to 60 to 80%, or even less than that, less than the current 46%. It really just depends on the opportunities that are presenting themselves. Naturally, if there's a lot of opportunities, if there's a market-wide event that is creating a lot of opportunities to invest, then I would expect that the individual stocks will go up significantly as a percentage of my portfolio, and they will trend down as a percentage of my portfolio if there is a lack of opportunities. As I mentioned, I'm happy to sit in cash for some extremely long periods of time. Currently, my cash position in the portfolio is 39.7%, and that isn't even all of the cash that I have. This is just cash that I've set aside specifically for my investment portfolio. I, of course, have money in my personal accounts for emergencies and other things, and as well as having money in my business company account for business expenses. But even just the money that I'm setting aside every single month, a percentage of my income to put into my investment portfolio, even that cash is currently sitting at 40%. But as I mentioned, I am completely comfortable with that because I know that if I'm patient, every now and then a really, really good opportunity will come along and I can deploy a significant amount of that cash into that opportunity. So I think that's enough about the broad composition of my portfolio. Let's get into some individual stocks and talk about how they have performed over the past 3 years on a compounded basis. So let's start with the smallest positions and work our way up in terms of individual stocks and index funds. And I have not excluded any stocks in my portfolio over the past 3 years. This is everything I've bought and sold, although when I looked at my portfolio, I actually hadn't sold a single stock in the past 3 years, but this is everything. You're about to see my entire investment portfolio and the performance of individual stocks as well as the overall portfolio. I'm going to go quite quickly through some of the smaller positions so that we just don't spend too much time on positions that I don't really care about or that don't influence the portfolio. So the smallest position is National Australia Bank. It currently represents 0.7% of my portfolio, and if you've seen any of my past investment portfolio videos, you would know that this isn't a business that I picked using Warren Buffett's strategy. It was a business that I invested in the first few months when I just started, and I'm only holding it for sentimental value. I have no interest in adding to this position, and I have no idea what this stock is going to do in the future. It's also been a terrible performer. It's generated just a 5.2% per year compounded return over the past 3 years. It's actually the second worst performer in my portfolio. and its all-time performance has been even worse, less than a 4% per year compounded return over the past 4 years that I've held this stock. The second smallest position in my portfolio is YY Incorporated. Again, this was an investment that I made a very, very long time ago in 2017, and it was made before I was following deeply Warren Buffett's core investing strategy, before I was deeply analyzing businesses. So again, it's a very speculative investment that I have no idea where it will go, and I have no interest in adding more to this position in the future. It currently represents just 0.9% of my overall portfolio, and the 3-year compounded return has been just 1.8% per year, and this was the worst performing stock in my portfolio. So as you can see, the two businesses that I did no analysis on and have held for a very long time are the two worst performing businesses in my portfolio, but fortunately they also represent a combined 1.8 or 1.6% of my portfolio, so they have very, very little influence on my overall return. Next, we have a couple of index funds that I added in late 2020. So these are not showing compounded multi-year returns because, of course, I've held them for less than 1 year, but we can take a look at them nonetheless. We first have VTS, which is a Vanguard US total share market index. So it's tracking the total US market, but it is listed on the Australian market, that index fund that is. It represents 2.5% of my portfolio and has delivered a compounded return of 13.38%. Although, as I mentioned, that is just the return from the past few months, 6 to 8 months or so, since I purchased it in late 2020. The next index fund is IVV, which is again listed on the ASX. This one is the iShares S&P 500, so 500 of the largest and most known companies in the United States. And this one represents 3.4% of my portfolio, and the return since late 2020 has been 11.97%. I don't think there's any point spending too much time talking about those positions because in terms of index funds, I'm just consistently contributing to them every single month. There's really no strategy there in terms of those index funds, as well as the one that I'm going to mention in just a couple of stocks. And I would rather spend more time talking about some of the individual businesses that I've deeply analyzed and have strategically purchased using the principles that I teach on this channel. And the first stock that fits into that category that is also in my portfolio is Facebook stock. And this one is a very small one, even though it was one that I deeply analyzed. It represents 4% of my portfolio, and over the past 3 years, it's delivered a 27.17 per year compounded return. I made this investment in mid-2018, and this was after the Cambridge Analytica stuff happened with Facebook, and they saw a decline in their European users, which was the first decline in users for the first time in the company's history in a particular quarter, and the stock ended up going down 20% in a single day on earnings, and then it trailed down another 50% throughout the remainder of 2018, and I took that as an opportunity to invest significantly into the business, or at the time it was significant, but since the stock resumed growing quite quickly and its stock actually bounced back 100% over the next 6 months after that, I didn't get an opportunity to invest more into that business. And since then, I've just held onto it. So as a result, it's become progressively a smaller and smaller percentage of my portfolio. The next stock in my portfolio is Texas Roadhouse, and this has been one of my best performing stocks in my portfolio over the past couple of years. I first invested into this business in mid-2019, and then I invested again in March of 2020. So for this business, I was able to invest more money because there were 2 different times over the course of a year where the stock was at a price that I was very happy to invest a decent amount of money into. It currently represents 7.7% of my portfolio, and since 2019, it's delivered a 72.66% per year compounded return. Particularly in March and April of 2020, Texas Roadhouse stock got absolutely smashed. It came down from about $70 per share down to $25 per share, and that was an extremely low price for the business that you were getting, which was a restaurant chain with no debt, no risk of going out of business, and also run by an absolutely terrific management team. It also had a number of other factors that, of course, I really, really liked. And those things meant that I was very happy to sink a significant amount of money into it. And since the pandemic, I think it has quadrupled in price. It's now $100 per share. So that one has certainly done extremely well, particularly over the past 12 months. The third largest position in my portfolio is the third index fund, which is VAS, the Vanguard Australian Shares Index. And this one tracks the top 300 businesses on the ASX. And it represents, again, 7.7% of my portfolio. Now, unlike the American index funds that we spoke about earlier, I've been investing into this index since early 2017. So I do have a 3-year compounded performance of investing in this index. And like the others, although I've only been doing it for a few months for the other ones, I've been investing into this index very, very regularly, doing dollar cost averaging where I'm coming back consistently and just buying it regardless of what the price of it is on that particular day. Over the past 3 years, it has delivered a 13.97% per year compounded return. And since 2017, it's delivered over 14% per year compounded. So the Australian market, if you've been investing consistently into it over the past few years, has done extremely well. The second largest position in my portfolio is corporate travel management, which was a business that I invested first into in February of 2020 and then again in March of 2020. This one represents 13% of my portfolio, making it the second largest individual stock in the portfolio. And it's also by far the best performing stock in my portfolio. So I've only had it for about a year, so I don't have sort of 3-year compounded results for it, and we don't really know how it's going to do over multiple years. But in terms of the individual year that we've had, or a little bit over a year, it's delivered 139% per year compounded return over about 13 or 14 months. Again, like Texas Roadhouse, in March of 2020, I invested significantly into this business. In fact, I invested much more into this business than I did any other business except for the remaining stock that we're about to talk about. And the reason why was it just got insanely cheap. It's a travel related business, but it was in the corporate travel and essential travel sector. So it wasn't actually hit as hard as some of the leisure travel businesses. They also had no debt. So they were in no position to go bankrupt, and the stock got slammed from $31 per share to $4.50, which was absolutely ridiculous. And I couldn't resist buying a significant amount of stock, and that one has done extremely well. And that leaves us with the last individual stock in my portfolio, which is of course Thor Industries. And I've held Thor Industries for an extremely long period of time. I think the first time I invested into this business was in early 2018, and it currently represents 20% of my overall portfolio. And even though corporate travel's return is impressive, it's an impressive return only over a single year. And I like businesses that can deliver extremely impressive returns for me over multiple years, and Thor Industries is one of those stocks. So over the past 3 years on a per year compounded basis, it's delivered 48.9% per year, which is an absolutely insane return, not only to achieve in a single year, but to have a compounded return of that over 3 years consecutively. After the first time that I invested in this business in 2018, the stock actually dropped over 50%, but because I had done my research and I was so confident on the business over the long term, as well as I was very, very confident on the valuation, I was very, very happy to consistently buy more over the course of multiple years, even while the stock was going down. And that is honestly the reason why Thor Industries has delivered such strong multi-year returns for my portfolio and such strong dollar returns, because it's been such a big position in my portfolio, because the stock didn't go down briefly and then immediately get expensive again, like Facebook did, for example, or even Texas Roadhouse after 1 year. It was a stock that was beaten down for multiple years. And that actually meant that I had a long time, a big opportunity over multiple years to see my income come in, set money aside for my investment portfolio, and consistently add to it. And honestly, those are the deals that I want to find. I want really great businesses that go through a period of not just 2 months where I can buy the stock, but 6 months, 12 months, maybe even 24 months where the stock is beaten down and I can consistently buy more of that stock. And now Thor Industries is the stock is starting to reflect the true value of the business, and it's been a very, very good business for me. So before this video gets too long, let's talk about the overall performance of my portfolio, and it's been just over a 50% per year compounded return over the past 3 years, which sector is massively outperforming the US market, the Australian market, the global markets, whichever market you want to look at, it really doesn't matter. That is going to absolutely crush it, particularly over a 3-year period where we had a recession in the middle. And the amazing thing is it's really on the back of 4 investments: Facebook, Texas Roadhouse, Corporate Travel Management, and Thought Industries. It's not like, as I said earlier, that I'm going out and buying and trading in and out of all of these businesses constantly. I am just very, very patient. I wait, and then an opportunity presents itself. And if I'm very confident on the business because I've done my research, I'm able to invest significantly into it, and it's able to deliver significant returns for my portfolio. Now, before we wrap up this video, I do need to talk about a couple of limitations to assessing my portfolio in this way, because it's not as clear cut as saying, hey, congratulations, you made a 50% per year compounded return. There are some problems with the way that I presented my portfolio, and I guess just generally problems with tracking and reviewing your portfolio as an individual. The main problem with that 50% return figure is that it excludes cash. It does not include the cash position that I've held over the past 3 years. And over the past 3 years, I've always held some level of cash. Sometimes it's been as low as 10%, but other times it's been as high as 60%. And that, of course, is going to have a negative influence on that overall return, because the cash has been earning, around 1 to 1.5% or even less currently, which means it's putting downward pressure if I have cash in that portfolio. And the real problem with assessing it, it's not as easy as saying, well, you're excluding cash, so that number doesn't mean anything. The problem is that cash fluctuates in my portfolio for 2 key reasons. One is, of course, that I'm waiting on the sideline. I'm partially waiting on the sideline for opportunities. And I completely accept that you should be including that cash in your returns, because that's a conscious, actionable decision to stay out of index funds or to stay out of the market. However, my cash position has also fluctuated significantly just based on my income, and therefore money that I'm setting aside and adding to the portfolio to then invest. And to me, I don't think it's entirely fair that you should be including changes in your income and how that affects your portfolio, because it's partially out of my control. And over the past couple of years, one significant influencer for why I've had so much cash, partly it's of course because I have been waiting for opportunities, but another significant factor is that my business has performed extremely well, way better than I expected over the past 18 months, for example. And the result of that is I've had more cash available to invest than I expected previously. Think of it this way. If you had a hedge fund that was, say, $10 million and you were managing $10 million, and then all of a sudden you started having really, really good returns, and you were a hedge fund manager that was in really, really high demand, and all of a sudden you had $100 million that people wanted to give you to invest, well, you've gone from having maybe a $10 million portfolio that was mostly invested to now having, like $8 million invested and $100 million in cash. So you wouldn't judge the hedge fund manager based on that huge pile of cash that they now have to figure out how to invest. So in that way, I think there needs to be a balance. There's no clean, easy way to add and assess cash in a portfolio. Part of it needs to be there because it is influencing, because you are kind of making decisions to hold back in cash, particularly if you're a value investor. But partially, you're going to have cash flowing into the portfolio that's going to impact your return negatively, and that may be out of your control. I'd love to hear your thoughts down in the comment section below about what you think about including cash in the portfolio, and whether you think there's any easy way to go about it. Because of course, you could just have a lump sum portfolio that you don't add any money to, and you could track the performance of that, and that would give a good indication of your skill, but it's not really an accurate reflection of my personal wealth and how I'm investing it, which is what I'm much more interested in sharing with you. As I mentioned at the start of the video, Learn by Example is open for very, very limited enrollment, and you can learn more about it down in the get out of my screen fly. You can learn more about it down in the description below, but basically a key part of that platform is getting access to real life examples principles of stock analysis, and you can see how I'm analyzing businesses that don't end up in my portfolio, and then how I'm analyzing businesses. Well, it's in the same way, but you can see the process that I go through for businesses like the 4 that I presented today in my portfolio, and how you can find opportunities like that to add to your portfolio to get some strong, consistent returns in your portfolio over the long term. So check out those links down in the description below. But with that said, I hope you guys got some value out of today's video. As always, please leave a like on the video if you did. But with that said, I'll be back next week with some more content. So I hope you guys have a great day, and I'll see you in the next video.